Well, there's no doubt that the European banking sector faces some significant challenges over the sort of short to medium term. Banks are essentially highly geared to the economies they operate in. We're expecting Euro area GDP to contract by 8% this year and still be 3% below end 2019 levels at the end of 2021. And that's in a scenario where the lockdowns are gradually eased and we get economic recovery. Clearly, we see them reimposed, and a second wave of infections, we could see economic contraction being significantly worse than that. So the sort of nearer term outlook, we think certainly from an earnings and asset quality and potentially capital perspective is pretty tough, and it's quite clear that you will get these spouts of market reaction, particularly where things like interest rates, which is such an important driver of earnings, are in question, and lower for longer feed. But I think the primary issues at the moment would be, when we're looking at banks, would be asset quality, absolutely. The NPL ratio going into the crisis of about 3%, obviously that will pick up on the back of the economic contraction and rising unemployment and bankruptcies. That will feed into earnings to the extent it hasn't already, of course. We've seen loan impairment charges rise from around about the sort of largest banks. The 5-year average has been about 20 basis points. That went up to 70 basis points. That's sort of in line with the 10-year, the worst point of the last 10 years, I suppose, 2-year average, but still below what we saw in the financial crisis. And of course, what we're going to see now in the second quarter is a fuller impact than we saw in the first quarter on earnings of lower interest rates, reduction in activity on fees and things like that. Perhaps with the exception of the investment and trading banks, they should have a better second quarter in those divisions, certainly.
Within private banking, we're looking now at higher savings rates in several European countries as people have obviously stayed home as a result of the lockdowns and stashed money away for those who've been fortunate enough to hold on to their jobs here. If you combine high savings rates with lower interest rates at this stage, what does that mean for private banking activity and mortgage lending and refinancing in particular?
Yeah, that's one area where we've seen banks certainly getting a notable hit on the I suppose the business volume side. Credit card payment balances and activities notably lower, so that will hit revenues for banks that are active in that. Remortgaging and mortgaging activity obviously lower as well. So that is a clear product of the increased level of savings. So we'd see revenue pressure there on the sort of retail banks, if you like, those income lines as a result of that.